We'll get started. And good morning, and thank you for joining our webinar, Variable Consideration and SAP RAR, How to Solve VC Challenges in SAP RAR. Today we will be focusing on variable consideration and showing you some of the insights and Bramasol special sauce that can help you solve the VC challenges using SAP RAR. In previous webinars, we shared some VC solutions, variable consideration, focused on aerospace and defense type challenges. This month, we are focused on challenges relating to rebates, coupons, forecast true-ups, and smaller scenarios which we have encountered during dozens of demos, workshops, and interactions with clients and prospects. Today's session will be given by Chris Ritterhern, our Director of Solutions and a leading expert in RAR. Next slide, Chris. As I said, today's speakers, here we are on housekeeping items. Thank you. Before we start, and I apologize for the delay, folks, before we start, I want to cover a few housekeeping items. This session is being recorded. Everyone but the presenters will be on mute. You can ask questions throughout the session by using the question area of your screen shown here. We will try to answer them live, or have someone answer them in the question tab throughout the broadcast. I encourage you to tweet to #RevWorkReady to engage with us in social media and share your thoughts or comments during the presentation. If you want to download a copy of this webinar and any of our dozen or so other webinars, we will make those available to you. You can also access them by visiting our home page. Next slide, please. Bramasol is the leader in revenue recognition services. We have the experience, expertise, processes, and tools to help you get RevRec ready. We have over 20 years as an SAP partner, and in fact, this is our 20th anniversary. We've participated in all 100% of live RAR implementations. We've led majority of the RAR ramp-ups, and we've done early testing on SAP RAR 1.2 and recently 1.3. We're co-innovators with SAP. We've tested all versions of SAP RAR, and we have SAP RAR certified consultants, and we have built our own SAP RAR RevRec Academy. They're our go-to partner for SAP and several of the key Big Four firms. In addition, we have demonstrated methodologies, including radar. We've done dozens of workshops, pilots, and consulting activity with over 2 to 3 dozen clients worldwide. I'd like to take a moment to talk about SAP RAR itself for those of you who are new to our broadcast. SAP RAR is built from the ground up to provide a flexible solution based on the new ASC 606 and IFRS 15 standards. SAP RAR is designed to simplify and automate your revenue accounting. If you take a look at the funnel slide we've shown here, we take all of your revenue documents, invoices, and bills, feed them into the RAR solution/engine, and make the appropriate correcting journal entries per the new regulations. So it is a solution that is designed for you to run in parallel and automate and simplify all of your RevRec activity. One key question that we've gotten in the workshops that I've been involved in and many of the customers is an understanding of how SAP RAR works. And I think it's important to understand as you watch the demo that Chris is doing and think about RAR to understand the difference. SAP RAR sits as a parallel engine to the SAP accounting system. It's integrated into it. It's a FICO or finance module that is plugged in, if you will, but it runs parallel. So many customers ask us, John, how will SAP RAR affect my billing and invoices? How will it affect my accounts receivable? Will I see a change and will it slow down that process? The answer to that is it won't change it and it won't slow down the process because RAR works in parallel to your operational processes or your operational accounting system. So all of the things that you currently do, whether you feed from your operational systems, including sales and distribution, CRM, hybrid billing, or other SAP components or non-SAP systems, all the feeds that you currently have working through your operational accounting, those do not change. They continue as is. Those feeds in the appropriate scenarios feed information into the SAP RAR, Revenue Accounting and Reporting Engine, that then makes the appropriate changes or adjustments to your journal entries to help you be compliant. The focus is to help you comply with the new regulations such that your P&L and your balance sheet reflect the appropriate revenue, deferred revenue, and other accounts that you would have. In addition, it provides a great management reporting tool that you can use, and we'll see a little bit of that later on, but it helps you with a management reporting tool that shows you information regarding your deferred revenue. So with that, I'm going to turn this over to Chris Ritterhern. It's my pleasure to continue to work with Chris on these, and Chris, take it over.
Thank you, John. Just a quick sound check. Can you hear me okay, John?
I can hear you.
Very good. Okay, thank you all for joining this morning or this afternoon, depending on your time zone. I'd like today to spend some time talking about what we've seen out there and some aspects that you can take advantage of with variable consideration. We're going to be talking about what is variable consideration, how do I account for this, and Bramasol's approach is based on our experience out there in implementing SAP RAR and meeting with multiple clients there, discussing their needs and requirements in the multitude of workshops that we conduct and hold with our prospects and clients as they're considering SAP RAR and RAR as a solution to their regulation requirements of the new reg. So one of the things that we're finding out is the new regulations highlight variable consideration, but we're finding it varies. And when I say it varies, we're finding that almost every company has a different definition of what they consider variable consideration, hence, I guess, the name variable. So that's something that we're finding out there. What I'm presenting today is sort of popular solutions that we've run across, or more common solutions that we've seen, plus some that we know are out there. We've dealt with some of the companies out there. We haven't necessarily seen full implementation of them, but we know that they're in the midst of designing solutions based on that. So real quick, what is revenue recognition? There's some simple 101 slides in here, so just keep in mind that we're going to skip through those as quickly, but they're part of the deck that when you ask for it afterwards, they're in there just to remind you of some of the basic things. So remember what revenue recognition is, but remember it's all about the 5-step process. Each step is a process, by the way, so it's not you go through 5 steps and you end up with this. Each one of those is a process. So what is variable consideration? Well, you can see here, and this is straight out of the book, so to speak, or the regulations, it has to do with the fact that you now have to explicitly delineate in your contracts any elements that you are concerned about or that have a potential for a return or a non-revenue or revenue impact. So, for example, one of the scenarios we're going to be doing first up is if I sell to distributors or resellers, and across a period of time, 90 days, 6 months, or a year, I typically experience a percentage of returns and or price concessions, and we'll talk about price concessions in a little bit. Under the new regs, you have to take that into account and hold back the revenue that you would ordinarily have run all the way through to the books. So that also gets to the concept of no longer is there this sell-through recognition of revenue, there's a sell-to. So when you sell to your distributor, it is recognized, but for example, let's say that over a period of 90 days you experience additional price discounting after the fact and maybe some returns, and it averages about 10% of invoices that you deal with that particular customer even or reseller. You need to hold that 10% back as a variable component while that uncertainty still exists. Once that uncertainty goes away, for example, after a timer or some other consideration, you can remove that and it becomes your revenue or whatever is remaining from that. This also takes into account, as John was mentioning, rebates count in this world, as well as any sort of performance bonuses or any other refunds or elements that go in there that you normally would have maybe tracked separately. And we're finding most companies do. They now have to be front and center and be clearly listed out where they're being tracked. Okay, so just real quick, what is a RAR contract? It's a collection of performance obligations, and we'll be looking at those in some details and some of the ways that we've provided ways for dealing with performance variable consideration. Performance obligations in the SAP RAR speak are basically about three major types: event-based, time-based, and percentage of completion. Today we'll be dealing with primarily event-based components of performance obligations for our solutions. And for those that are interested in further discussions, we can talk about things like time-based. For example, when I talked about expiration of the uncertainty, we've used a combination of event and time-based so that the holdback exists for a period of, say, 90 days and then automatically expires itself and rolls the revenue back in. And we talk about how that can be done using the SAP RAR tool. Okay, just real quick, what is the flow? Remember, it starts in the SAP ECC world. There is a transfer routine. Today we're not going to be explicitly running the transfer routine. We have some shortcuts for that, and I'll be talking about that so we can just get it straight in and look at the major action of what we really want to see today, and that is variable consideration. Okay, our environment, by the way, is up in the Amazon space, the cloud space, and we do our demos from there. We provide our performance up. We provide our prototype systems out there, and it is the most current version, 1.2. As well as running on Enhancement Pack 7. So just idea where it's out there, that allows us to do rapid demonstrations and also allows us to make copies of that system for clients to do prototypes with. Okay, so let's talk about some use cases. So high level, it's something like this. This is the decision making that needs to take place. You have a contract as defined in the new regulations or contract line item. And we look at what are the variable aspects to it. For example, I was saying about price concessions or returns. There might be things like collectability is one we've heard, or aspects that you have in the contract that you have always taken into consideration but never had to formally account for. So then we say, okay, well, how can we put that in as a RAR adjuster line, potential changes to the standalone selling price, and then roll that into the contract. So this is sort of the big picture. We'll be doing something like that today. So we have 4 examples of variable consideration that we're going to be talking through. The most popular one we're running across right now is variable consideration as a holdback, and you'll see why I'm using that term as we get through it. Then we'll be talking about what we call a forecast true-up scenario, then minimum license or contract value, and then another concept is consumer price index adder. We've also seen this come under the concept of time value of money, where customers have multi-year contracts, but they need to add some sort of an escalator or adjustment for cost against the money or value they want to charge as an addition for letting the contract go that period of time. Okay, so variable consideration and holdback. Let's talk specifically about this. Aspects to consider in this use case are, it's the concept of after-the-fact discounts or credits, commonly referred to as price concessions. We see this quite often in the situation where I provide something to a customer or a reseller or distributor, commonly it's some sort of resale channel, and they call back and say, hey, I can get this really big deal, but I need you to share some of the pain with me. I'm sorry, some of the opportunity with me, and I'm going to ask for you an additional discount, in which case you would provide an invoice credit, an invoice correction, changing the price of maybe all the material they have remaining or some material of it, and it'd be against an existing invoice that already went out the door. We're using a 90-day window here. One example also is stock rotation. Maybe you allow your clients or customers or distributors to do a stock rotation in a period of time. So, and maybe there's a limit to the percentage of that. And one of the things is, what vehicles will I use in standard SAP ECC so I can audit activity? One of the key things that Bramasol looks at is the longevity of solutions that we provide from the perspective of being able to maintain and work with it, and also being able to provide a clear path for accounting to audit the activity. So things like ongoing maintenance, reevaluation of the variable aspects, because we find that, over time you constantly are looking at these, and we find, hey, last quarter it was about a 10% holdback. This time it's trending towards about 12% when we look at all the things that took place, or maybe it's gone down or up, so that you can allow others to maintain that track. And then what reporting can I utilize and within the SAP standards to look at these aspects like variable consideration? We'll show you an example of that. Okay, onward. So our scenario is something like this. I know it's a bit busy, but in fact, this is what's going to go on. The first part, standard process, we're going to have an order that goes through that process. Very simple, no big deal. The next part is what we call the price concession, and this is where variable consideration comes in. So it starts with the standard process, and there's a holdback value that you're going to see in the contract as we go through it. Then we're going to do a correction, and what we did is we put an adjustment function in there to decrement the holdback value as opposed to just doing the invoice correction. So the invoice correction absolutely works correctly against the particular material the price is being corrected against. But additionally, we've added a component that then adjusts against that holdback value. You'll see that in a minute. And then same thing, similar concept with returns. So this is the flow that we're going to be looking at today. So here's the big picture. So our scenario today is going to involve 4 materials. And then what we have is a 5th material that gets added automatically into the sales order. Any sales order that's been marked as variable considerable, for lack of a better term. In this case, we're saying we want 10% of the value funded or held back. And it can be looked at a couple of ways. One is in the IFRS rules. It'll go straight to a contract liability so that you see it on your books. From the GAAP side, we can have RAR as the holder of that value, so it just sits in the RAR space, and eventually it either is zeroed out and shows up against the 4 materials that are there. As this is an accounting presentation, primarily it's a accounting presentation without a good spreadsheet, just to give you the numbers so you can kind of look at how it's calculated. And we're going to be going through this in just a second here. Okay, so let's take a look at the aspects of this. So here I am, and let me just bring my SAP system up. Here we go. For all of you, I hope, John, can you see the SAP screen now? I'm assuming that's a yes, John. Okay.
Yes, Chris.
So
I was on mute. It's yes.
Okay, thank you. All right, so let's talk about what we've got going here. So let's look at the finished product, and then we'll create it from scratch so you can see how it occurs. So in this case, I happen to have a sales order laying around, and let's take a look at its current state, so to speak, here. So here I am, and you can see here. Here's my various components, and then here is my 5th line. That's the variable consideration element that's holding back a value based on the total sales order value. And it goes into the RAR contract as a holdback, and that's the number that we're adjusting against in those 2 scenarios where I said that the Bramasol has an RAR adjuster. This is specifically what it's adjusting against. In this scenario, there's been some activity against this one, and we can see here there's been an invoice issued, but nothing further. So we'll take a look at this now and go through this scenario and get a sense of how it operates. So let's create a sales order from scratch, and we'll see what this looks like. Okay, so put in my customer number as per usual. My indicator that I told about this is a flag. We have a workflow built around sales orders, create changes that looks at the PO field. If it sees the word RAR, it actually does the transfer to it. And then we're going to indicate that this is a RAR relevant sales order by going over to a tab that we've added in there, and we're going to say, okay, here's the current percentage of the variable consideration is 10%. There are other ways to do this. This is one particular way that we chose to do this so that we could flow through here. So let me put in my materials. So material A, B, and C. There we go. Okay, and let's put some quantities on that. And here we go. There's my sales order as created. Nothing special, just a standard sales order. It has a value of about $4,650. Okay, now I'm going to save that, and that's where some of the magic starts to take place. So I'm saving this now. So sales order 1332 has been created. And now if I were actually go back in and look at that particular sales order, I'll see that there's been an element added now, and that's this 5th line here, and that's the variable consideration. Because I marked it as variable relevant using that technique I just showed you. There's a couple ways that we've done this. One is an explicit add of this material. The other one is more this automated fashion that I'm using today. Okay, so here we go, and that's the order as we have created out there. Let's take a look at the created RAR contract so we can see what it looks like from an RAR perspective. So now I'm going to go look at that sales order 1332. And we'll take a peek at what that looks like, and we'll see that both the IFRS and the US GAAP contracts have been created. So I'm just going to look here, and I'll see that I've got 5 performance obligations, 4 standard, and then the 5th one is my placeholder. So the concept here, and here's my funding of it. Now the concept here is that this is never ever delivered or invoiced. It's a holder of revenue. So it's funded itself out of the revenue stream, and it's holding now that $465 and some cents. So very quickly, we'll just go through some standard stuff here. Let's deliver and post this thing here. So we're just going to go through some standard operational aspects. And we'll just say, okay, that's great. Well, let's say this is posted. That's great. No great shakes there. Standards functionality. Let's generate the invoice, and let's save it. So now we're good. So that contract is now delivered an invoice. It's paid for, and we're done from that perspective. Let's just update my RAR system real quick. So we've done that. And if I look here, and if for folks that are watching this, if you see this column here that says invoice, when I hit refresh, you'll see that's now filled in. So here we go. We've invoiced it. That's great. Everything's great. Wonderful. Now, let's say that the situation that the client calls up and says, hey, I got a really cool deal, and but I need a break on some of the items you already sent me. So what we're going to do is we're going to do a invoice correction. We're going to give him that price concession that he's asking for. So let's do that. But before I do that, let's take a look at my sales order document and pull up my invoice, because we're going to be doing that. So here's my sales order. Let's look at the document flow at this point. And let's see the invoice, because we're going to be offering a credit for one of the items against this particular invoice. Okay, here we go. So it's going to say, okay, give me that invoice number. We'll say, here you go. And we're just going to do it on one of the line items here. So let's change a couple of things here. Let's just take off the billing block. And let's tell them that the order reason is a price concession. Okay. And let's just knock off these particular items, because we're not going to be dealing with those. Great. And we're going to say that for half of the merchandise that's been shipped out there, we're going to give them a new price of $7.50. So there we go. That's all our changes. All we needed to do, everything's pretty much ready to go. We'll save this invoice correction. So standard in the system, it's saved. And then we'll invoice against it. And save that. Okay, so what did that do exactly? Let's just make sure that my contract is updated. Let's look at the RAR contract now. And what you're going to do is see this number here, $465 at the very bottom of the screen. When I hit refresh, you're going to see that value change. Because what we did was we gave them a price discount against the first material. That's this line item up here. And then when that came through, the Bramasol function came through and made an adjustment to the value that we were holding back, because we've actually done it against the material. So it's correctly there. The document flow, which I'm going to refresh up here for just a second so you can see the document flow in background as we talk about this. So you can see here, if I look at those two things simultaneously, there's my invoice correction credit memo, and then what I've done is I've pulled that adjustment against there. So pretty straightforward from the perspective of what I'm doing. Similarly, when I do a return, it will take the same value here and it will adjust off this value. Now, one of the questions that comes to mind when I'm doing this, by the way, is, what's my position on variable consideration? Where am I with respect to all of those out there, by the way? And then let's talk about that for just a minute. So we're going to go forward and kind of look at the big picture, and then we're going to come back and talk about some details like where it got posted and what happened from that perspective. So I'm going to look here at my reporting tool that I'm using today. This is SAP Lumira. And what is the virtue about this particular reporting tool is I'm reporting directly into the RAR system, and I'm going to go look at my variable consideration dashboard. So my variable consideration tells me that I have about $50,000 in contracts subject to variable consideration. I'm currently standing on about $5,000 in variable consideration. So I'm able to quickly see here what's my position, what revenue stream is being held back, so to speak, or held to the side currently. And I can look at the mix of this particular aspect here from, what are the items that are doing it. I can look at this component and say, okay, show me the details from this perspective here. So there's multiple ways that I can look at it. Let me just put this in preview. Most of the charts are operating. There we go. So I hold over, I can see, okay, these are the materials that are actually in value. I can see here that material B is the biggest one that I'm holding variable consideration against. My next biggest one is material A. Or I can go to my bar graph here and look at what is the actual amount in variable considerations as being put as contract price, and what's the revenue price, meaning what's the remaining of those out there. So I can look at those kinds of values if I want to. Very easy to look at that functionality. So let's go back and let's talk a little bit about what happened from where we were just now. Okay, so we just created a sales order with that particular functionality. We saw that go rolling in there. We did a change against it. We saw that change. Now, this is the part that I want to point out. Depending on which accounting principle you use, you can see here that I've actually got a posting that I did against that particular contract, and the value of that variable consideration went straight in as a contract liability. So I can actually adjust it. I know there's a lot going on here, by the way. And when John said RAR simplifies the world, what's nice is I can sleep better at night because I know that RAR is on the job making all the correct adjustment entries in and out of my general ledger so that my balance is correct and in compliance with the new regulations. And this is an example here where I've decided that any holdbacks I want to show as a liability. You can also do it another way where I just let RAR hold it and just let it flow through the changes to the materials. And then at some point in time, I can then say, okay, that's expired, and now that holdback no longer exists. Okay, onward. And you can see here things get pretty busy. Here's we do the adjustments as they're made. We can go into the standard SAP process flow and look at those. So very auditable. We can backtrack exactly where the changes were made and the dollar values were injected. And you can see that over time, you potentially could have many adjustments and many corrections. In this one, we have at least 2 corrections, 3 actually, and we have a return in there too. So multiple things that go on, and accurately will be tracked in the RAR system, and as I do my RAR postings, it'll be correctly taken care of. Okay. Another example, let's move on here, of variable consideration is something we call consumer price index here, and this is a simple example where we have a value, and then there's another value that's calculated as a percentage or added back in here, and then that flows through to the system here. So in this case, we have a fee that's brought in here, and it's held through and kept in as part of the system. And any time in this particular contract, they said, well, every year we need to make a change. So we said, we'll just add a line item, and that'll be your change to the contract, and that provides all kinds of tracking and maintenance and from that perspective. And you can see it as it flows through the particular system. Another scenario we run across is what we call contract minimum usage. This is another flavor of variable consideration. And what this particular scenario engages in terms of contract minimum is it tells me that I've got a situation, for example, in this scenario here, that I'm going to supply materials to a customer, but no matter what they do, I want to get at least $3,000 out of the deal. So I don't know what particular mix of components. Now, I've only got 2 components here, but just to give you an idea of how straightforward it is. So what's going to happen is that as I invoice them, I'm going to decrement against my minimum contract value and then move forward. So let's take a look at what that looks like here in the system here. So here we are in my system. We're going to look at the minimum contract cockpit that Bramasol has created for this purpose, and let's look at that particular contract. So I have my contract here, and let's see what my position is here. All right, so everybody's wondering, oh, wait a sec, where did that come from? Well, good question. Let's take a look at the sales order behind that. So I can see it's particularly sales order 1102. Let's take a look at that particular sales order and get a sense of what it looks like from the genesis of the thing or the start of it. So here I am, and I've got my particular sales order here, and what I've done is, again, look, I've added a line item, and I've called it minimum. and its value is a percentage of these values out here. Now, I also did the second thing was I flagged this using that tab that we have out there, saying this is a decreasing minimum contract. That's how it's known to be picked up by the contract, and here's my starting minimum. I can automate these things. These are set up from a demo perspective so you can see how they operate. This item is an invoice-only item. So, for example, it could be a royalty that's paid or some sort of concession that's paid every time this particular customer provides these models out there or something like that. And let's look at the RAR contract that's created as a result of that here. Let me just get this screen out of the way here just a second, and let's go take a look at the RAR contract that was created as a result of this. My system come up here. All right, so let's take a look at that RAR contract and as it exists from the perspective of this particular element here. Let's look at the GAAP version of the RAR contract. These slides, by the way, are pretty much in the contract so you can see what they look like. And let's look at my current and the presentation so that for those that get asked for or obtain a copy afterwards, I can see what that looks like. So I can see here in my contract, the minimum I've got is about $2,000 sitting out there, by the way. Okay, for those that are out there saying, hey, it's double counted, this is a demo, so I get to kind of surface things in a way so they're easily seen. In production, obviously, wouldn't particularly do it that way. So let's say that what we're going to do is now we're going to go back to that cockpit, and what we're going to do, let's see, where is my, there it is. Okay, good. So we're going to go back to that cockpit, and you can see here I've got 100 of these items here. Let's say that I've got 50 remaining on this one here, so I'm going to say, okay, we're going to deliver or invoice the remaining 50. So when I submit this, what's happening is this contract in the background is doing a few things. It's making an update to the actual sales order and the standard ECC processes for delivery, invoicing, etc. And then it's adjusting the sales order, and then finally what it's doing is it's making a change to the revenue contract to reflect the change in value here. So if I look here at my RAR contract, and I see here's my minimum value down here, let's hit refresh, and you'll see that that will change now from 2,000, and here we go, it changes to 1,500. So what we've done is we've decremented the minimum contract value. I can see that I have my normal delivery of items up here. So I've delivered 150, there's 150 out there delivered. So this is an example of we're maintaining this variable consideration. And similarly, you can use that cockpit functionality to say, where am I on my contract minimums? And there's rules like, for example, once you hit the floor, so if I look here, once I hit the floor, I don't take it beyond 0, for example. Once I go to 0 at 0, I got what I needed as a minimum out there, but in the meantime, my revenue stream, per the new regs, the contract said, any element in the contract has to be recognized in any element in the agreement with the customer has to recognize in the revenue contract. And one of the part was, no matter what you do, I get this minimum revenue stream, and now I've been able to recognize that because of my capability with that. Okay, onward. So we just looked at this one here, minimum contract. The next one we're going to talk about is what we call forecast true-up, and that's one that we've run across quite often. Here's our cockpit creates this. And let's talk about forecast true-up. So what is forecast true-up? So the scenario is this. I've got a material that I know the customer is going to take delivery on, but I don't know, or invoice or royalty or usage. And previously what I used to do was I said, you're licensed to use all these things, and you tell me which models you ship that use my intellectual property or component, and then I'll send you an invoice for that value. Well, according to the regulations, you actually have to forecast what the revenue stream is going forward. And you might say, gee, I don't know what they're going to sell of what. So in this case, I can actually tie it really closely to particular materials saying that, well, I don't know what they're going to use, but I figured it's about $1,000. So again, we're using RAR as the holder of this record, so to speak. And when I look at this kind of a contract over here in my SAP system, again, let's go over to my forecast true-up cockpit. Very similar concept. So I'm going to look at one of my particular contracts out here and see where I am on this particular contract. You can see here, this is where I am. Very similar functionality, only things are laid out in a one-to-one fashion. I'm looking at just the materials. I have an order quantity here of 100. There's 89 remaining. There's my price. Here's my value. And let's say, well, they just told me they used another 15. So I can come in here and hit submit. It will generate the invoice, and it will decrement the the remaining value, and it'll also do the same thing in the RAR contract. So it takes care of that for me automatically. So I don't have to worry about that, and I'm all square from a perspective of RAR and the tracking and the functionality that goes on from that perspective. So that's forecast true up, a very common one we're running across here, and this is an example of how it operates, and then it's actually tracking and correcting automatically the RAR contract as we invoice components to it. Okay, so that was a walkthrough of variable consideration. I know it was a bit brief for you folks. For those who would like some more information or further discussion, please feel free to contact and reach out to us. We're constantly looking at the library of things that we're providing to customers out there and requests that we're seeing out there and providing working examples so that they can rapidly understand, okay, here's how the regulation applies and the concept that we've heard about this variable consideration or rebates, promotions, and I'm looking at an actual real life, oh, here's the flowing through, here's the GL accounts that were updated, and let me begin the discussion about, okay, from an accounting perspective, is that in alignment with how we wanted to deal with it? From a maintenance perspective, how does it work from the people having to maintain this information? And from a go-forward perspective, what's my overall auditability, and at the end of the day, am I in compliance per, let's say, when my auditors look at the process. So these are pre-done. It allows us to move very quickly through our discussions with our clients and these workshops that I was talking about a little bit earlier. Okay, with that, I'm going to turn it back over to John. And
hey,
John,
Chris, before we dive into this, folks, Chris, actually, there are a couple of questions on the line, and one of the things we did this time was ask people to submit questions in advance. So let me see if we can handle a couple of questions here. So Chris, you did a great job of showing us the forecast true up, and we talked a little bit about those things, but how would you handle, or can you retouch and talk a little bit about the idea of volume discounts as time goes on? So for example, let's say there's a tiered discounting based on the amount that you purchase, and a customer hits 1,000, 2,000, 3,000, and they have different ways of getting discounting. Do you have a thought on how we might approach that?
Yeah, that's a good question, John, and that's actually come up, and we've actually are in the midst of working on a demoable solution for that. And that's the concept of I have multiple sales contracts out there to the same customer, and they're ordering multiple things, but I'm tracking how many of this particular item that over these half a dozen or a dozen sales orders that they've been purchasing. If they hit a certain value, then I'm going to retro or give them a discount that now applies retro or applies to future orders. So one of the ways that we recommend that we're looking at is really to set up sort of the idea of a master RAR contract. And it's tied back to the sales orders that are relevant to it are through a similar kind of that information tab. You look at that RAR information tab where we inject somewhere into that sales order that is the holder of this potential promotion value or potential discount, so that whenever you're doing things, it's kind of updating back to that master contract so that the RAR POBs related to that are automatically updated and eventually maybe hit the threshold where it becomes relevant for this particular customer and then hits that customer's accounts from a GL perspective and the sales revenue from the perspective of sales order. Or it becomes applicable in future sales orders. So we can do that tie back. And the operative term you heard me say here is that we have a RAR contract that represents that promised discount that I've contracted with my customer. So the operative term you hear me saying is contract, aka I've got to recognize it, and B, I'm going to use a sales order itself as a vehicle, and then C, what I'm going to do is take that master sales order, so to speak, and I'm just calling it that by convention, and I'm going to inject that number into lower contracts that purchase and take place against this particular customer. Good question.
Yeah, no, and a couple of those came up. Another question that came up is just, I know we've talked about it in one of our other webinars, but if you could just touch on the concept as it relates to POC, right, percent of completion, but things like performance bonuses and performance penalties based on, those milestones. There were a couple of questions that came up on that. Can you just talk briefly about that?
Yeah, certainly the whole concept of performance bonuses and commissions, that's a huge subject, by the way. I remember one of my colleagues who was in sales, he used to say, here's the standard line when you're a sales representative whenever asked how it's going. gee, my territory's a little small and the commissions are a little light. Commission's huge discussion. Performance budget is huge discussion, by the way. And we've run across a number of ways to model it. Where we spend most of our time is really talking about what is the rule in the company, because if it's percentage, we can create a performance obligation. If it's an item that's a rider in a sales order, it's a lot simpler to audit and see from a perspective, but commonly we're seeing performance and bonuses operate much like that concept of a volume rebate, where it's across a period of time, or it's open for action across multiple contracts. So we know RAR is a really good mechanism for modeling this. Really where we spend our time is what is the most appropriate way to model it.
Yep. Thanks. That's great. And I know that we've also had, when we think of performance bonuses and penalties from a project systems perspective, and folks, we have a couple of webinars out there that talk about that, and you're certainly welcome to reach out to us directly and talk about how those work from a percent of completion milestones as well. So with that, Chris, let me see if we have any more questions online. Folks, any more questions? Oh, we have a few more. Hold on, Chris, let me. How would you deal with things like right of return?
Oh, good question. And there actually is yeah, that's a good question. There's actually a standard functionality in RAR that we've modeled using POBs, this right of return. And that is, basically, you can think about it again, it's a holder that either increases or decrements in time. And we actually have a standard functionality that actually isn't involving code. It's just a capability within SAP RAR to do this right of return functionality where you have a placeholder that the customer potentially can take advantage of or use in time. So that's just a nice functionality SAP has built into the RAR module. We actually have working models to show that. Perhaps, John, we could put that in another future webinar.
I think that's a great idea. We'll focus on that. Kamal from Siemens asked a question specifically around cash discounts and variable consideration. How might we deal with that?
Yeah, and that, that gets into the concept on the AR side of the house, so to speak. If it's something that you routinely give and it becomes a component of all contracts, you do have to take it in consideration when you bill the customer. So the operative term there is, do I routinely do it? And if that's the case, then you do have to create a variable a component within your sales order or underlying contract that has that value.
Okay. Yeah, and what we can do, Kamal, is certainly, and for anyone else who's interested, we can have a much more lengthy discussion and talk about, that specific scenario for you, but we're glad to do that. I also got a couple of interesting questions from a number of folks, Chris, around how does BRF Plus fall into this, and how might you use BRF Plus in determining some of these variable consideration POBs, or the mapping of them to your overall RA contract, if you will?
And that's actually another good question too, by the way, is that we actually are using BRF Plus rules in a couple of these scenarios I showed you. It's nice that SAP has written the application that way. It allows me to almost script a business rule and create it in place saying, if this, then that, from a power user or somebody who's knowledgeable in development, not necessarily, deep down ABAP coding. So we actually are using BRF Plus rules. We tend to use those as much as possible because they're part of the RAR framework, and they're very maintainable and version insulated in time.
Cool. Yeah, and a lot of the work that we've done is on helping our clients understand how to do that. So thank you for that, Chris. With that, we have no more questions online, and we've covered most of the questions in our pre-submits. Folks, what I wanted to do is just take a moment to remind you that most companies have a January 2018 deadline, and that puts you 14 months away from going live. And quite frankly, with that, you have a parallel reporting requirement. And if you are considering using even just one quarter of parallel reporting, that means that you have less than a year to get ready. And we're finding a lot of folks coming to us and asking, wow, how can Bramasol help me get ready? That's a lot to get done in a year. If you've already started your accounting assessment, That's good news, and many of our customers have. Some are just starting, but that's okay. And if you click the build, so here's where we are today. If you look at this, that again leaves us, what we recommend is you start with a pilot, and I will be very specific to call this a pilot. The idea being that you are starting small, creating your foundation from which you will then build your implementation. We strongly recommend you can do an 8-week pilot program followed by a 9-month implementation. That is a very tight time frame, but if you use some of the tools that we have, including some applied agile methodologies, we can help you get that done. And then parallel reporting for 1 quarter will provide you with insights, and then we'll provide you with the post-go-live hypercare. So for those of you who are concerned, Bramasol has tools and methodologies, and we can help you get this done in 12 months. Let us know. Reach out to us. You can come to our website, or you can reach out directly to me at jfroelich@bramasol.com, and we can get you in touch with our sales team and folks like Chris and others who've been on our webinars. So with that, what I would like to do is, we've been trying to keep these under an hour. One thing I do want to let you know is this will be available. When you do think about a pilot program, or you think about an implementer, remember that this is much about the resources you bring to the table. So having those resources available will accelerate your program. The one thing we would tell you, please do not skimp on, is your pilot program. A successful pilot program will lay the foundation to help you accelerate your implementation and allow you to be RevRec ready in 12 months. Next slide, Chris. So, Chris, you want to handle this, or you want me to do it?
Yeah, so remember, what we're trying to show you today, and hopefully some of those you can see out there, is that SAP RAR can be used in variable consideration scenarios. And we're finding that the RAR is a strong tool that we can use in various aspects. So you saw a couple examples, and in the Q&A you heard some additional ideas about that. And then most importantly is, make sure that as you engage and go forward with this component, that you engage with a partner who knows how to expand the paradigm, and make sure that we all look at that user acceptance and make sure that we can obtain that as we roll this out, because this is net new functionality. And one of the things that we're very keen on is the aspect of user acceptance, and that is, what do they have to do to maintain this? Where do they have to go to do things like that? For example, we've taken the paradigm into developing Fiori tiles around RAR, so perhaps in a future webinar we'll be talking about that. I think we did it once before. We might be hitting that again in some more detail. That gives you an idea of some of the examples behind that.
All right. Well, thanks everybody for attending, and I appreciate everybody coming. This is again our 12th in a series, so we've had an entire year of successful webinars, and they're successful thanks to the team like Chris, and also thanks to the folks who attend. We've had over 1,000 people view the webinars live. We've had over hundreds of people download them, so I encourage you to get out there, take a look at them, and reach out to us. So the only question I have with less than a year to go till you're ready to dual report is, will you be RevRec ready? Thank you, everybody, and have a terrific day.